Ladies and gentlemen, could I ask you to take your seats, please? Good afternoon and welcome. We're back. Yes, thank you. Resources Rising Stars is back in Melbourne. Nicholas Reid and I are delighted to see so many friendly faces here today. It was August 2019 that Resources Rising Stars was last on the road. So it's fantastic to be back with you all. Thanks for joining us. We have a full house here today, almost 200 people. So thanks for your support. We're going to have a really enjoyable and informative afternoon. A big warm welcome too to all those joining us live online today. We've taken Resources Rising Stars out to the world, beaming to investors everywhere, direct from the lovely RACV Club in the heart of Melbourne. To all those online, thanks very much for joining us. It's great to have you. Before we move into today's presentations, a couple of little things that I think are well worthy of mentioning. Resources Rising Stars is all about putting investors and companies together. And as part of our mission, we publish a weekly newsletter or a wrap every Friday morning, and it's free for investors. I really encourage you, if you're not on our list to receive that, simply click on the QR code on your table and that will take you to the landing page and you can register. Our weekly wrap is really good reading, valuable reading for investors in this space. It features a column from Barry Fitzgerald, one of Australia's veteran resources writers, who's here today and joins us for the lunch. Thanks very much, Barry, for coming along. And also a column from Tim Treadgold, another highly regarded finance commentator based in Perth who's been covering this space well back since the Poseidon boom of the late 60s. It's free, it's valuable, and it's delivered to your inbox every Friday morning. So click on the code and it's yours. Also, that code will take you to a landing page to register for our annual conference on the Gold Coast. I know many of you are already registered for that. We'd love to have you along. Again, it's free for investors. 2 days of presentations from resources companies and a great opportunity for investors to speak directly to those running the companies, see the whites of their eyes, get a feel for the story. It gives retail investors the same opportunity that fund managers and the like get every day of the week. If you'd like to join us on the Gold Coast at the lovely Royal Pines Resort, complete with kangaroos and a world-class golf course, again, click on the QR code and we'd be delighted to have you along. Moving into today's presentations, our first presentation today is a cracker. Bellevue Gold has prided itself on doing everything it said it would do. They said they were going to make a high-grade gold discovery in the heart of Western Australia, and they did it. They've grown that inventory. It's a high-grade inventory, a genuine high-grade inventory. It's not high-grade, it's a cliche now in the gold mining industry, isn't it? This is genuine high-grade. It's a growing project, and they're now piecing together the Stage 2 feasibility study, taking into account the past 6 months or so of fantastic exploration results they've been putting to the market. And their timing couldn't be better, could it? With all the talk of inflation, gold surging back, the hunt's on for gold stocks, which give you not only a proxy for the gold price, but some genuine organic growth, some steam of their own. To tell us all about Bellevue Gold and what's ahead, please welcome Managing Director Steve Parsons.
Great. Thanks very much, Paul, and thanks very much for the invite to be presenting today. It's great to be outside of Western Australia and getting around the various states and presenting. So I'll tell you a little bit about Bellevue Gold and what we're up to. Some of you may be familiar with the story and others not. And I guess, probably the first place to start, though, is the gold price. And, after the 2 decades of being in the gold industry myself, certainly gold is looking very strong at the moment, as people probably know. There's a couple of, key reasons for that. You've got inflation out there, which everyone's talking about on a day-to-day basis, and that's very real, and we're seeing that in Western Australia with everything that we're doing at the moment and costs going up around the world. And the other factor as well that everyone should be taking into account is that interest rates are almost at record lows, and we're quite lucky here in Australia, but you certainly go up to Europe and North America and you're seeing close to zero or negative interest rates. And so those two things combined, you'll see the hedging into gold, and I think that this is probably the strongest positioning for gold to be in for a long time, and certainly since the last 20 years that I've been involved in it. And of course, it's a perfect segue into, do you buy a bar of gold or do you buy a gold company? And if you're going to buy a gold company, well, you certainly want to be buying one that's going to be highly profitable. In Bellevue, you'll see that we're on track for being that. You want to be in a good jurisdiction and you want to have growth profile as well. And hopefully you'll get that as a takeaway from today's presentation. So the normal disclaimers and forward-looking statements that will be set in this presentation to read in your own time, and everything is on the ASX platform and on our website, and I certainly encourage everyone to go there and have a look. So we had our discovery about 3 years ago now. We drilled our very first drill hole. I was on the ground when we did that. It was 3 metres at 27 grams per tonne gold, which is pretty incredible from surface. And since that discovery drill hole, we've had drill rigs turning 24/7. We currently have 9 drill rigs on site turning, and we've grown our resource to 2.7 million ounces of gold at a fairly impressive 9.9 grams per tonne. And when you think of global projects around the world, it's typically 1 gram is what you see for ore bodies, but this is 10 times the number. So we really are blessed. And the resource grows at about 70,000 ounces a month in, month out, and we've done that since day one. And the important thing is that we put in place a dual track strategy of both exploration and moving into development and production. And the exploration strategy for us is very much keep those drill rigs turning, keep that resource growing, and that's what you're seeing with those 9 drill rigs turning, and that will continue on indefinitely. And on the flip side, on that dual track strategy is about getting into production and obviously the re-rating that you have and the power of production. And so what we did is came out with our very first, with our maiden feasibility study a couple of months ago now, and that demonstrates that this is a really profitable, really robust mine. The numbers that came out from it just on our phase 1 feasibility study is a 7.5-year mine life, some of the lowest all-in sustaining costs on the planet with 1,070 Australian dollars all-in sustaining cost. That includes everything. And of course, a production profile of about 160,000 ounces per annum for the first 5 years and 150 from that. So really, really good numbers. But what we did was all the drilling and information that was put into that study was stopped in November of last year. And so here we are 6 months later. So an upgrade to that feasibility study is coming out in the next couple of months around the middle of the year. And that upgrade is literally taking all the resources and all the drilling that we've done with those 9 rigs since that moment in time and upgrading. And so you'll see hopefully something bigger and better coming out in the very near future. And of course, as I said, the discovery costs are very low. We're discovering gold for about $20 Australian an ounce, and that's been consistent the whole way through, and we expect that to continue as well. It's a very simple project, very simple metallurgy, small processing plant, small capital costs, and very straightforward to get up and running. And we're on track for pouring gold on Christmas next year, so that's not that far away. The share price graph over the last, since we had the discovery, and you can see it's been a great appreciation over that time. There's obviously highs and lows and dips and peaks, and clearly now is one of those opportunities to be buying in. We're very cashed up with $116 million in the bank, and that's obviously the basis for our funding. You're going to see in place in July of this year us coming out to the market with how the debt funding is looking, and we're on track with that. We currently have 13 banks in the data room going through that, and we expect to have some very good news on that in the very, very near future. We are tightly held. Management owns just under 7% of the company. In fact, every person who works in Bellevue Gold does own shares in the company, and these have been bought on market. So, there's a strong belief in what the team is doing on site. The register is a global institutional register as well. You can see some of our major shareholders there with the likes of BlackRock, Van Eck, one of the biggest gold funds in the world, as well as 1832 and the likes as well. And this is, just shows an example of when you look at the share price graph on where it's been, and this graph basically is just you've probably all seen it before. It's a classic example of companies that go from exploration into development and into production, and it's the share price trend over that time, what typically sort of happens. And obviously, the exploration phase, big ramp up in the share price, everyone's excited, and then the flat period during development, and then the re-rating into production, the power of production. And you go from being a PNAV, way you're rated on, valued, through to an enterprise value at EBITDA type rating. And of course, in the gold space, that can range from like sort of 4 to 10 times EBITDA. So the big up-rating happens there. So for us, typically most development companies will stop the drilling, they'll focus on getting their project up and running and then go from there. However, Bellevue, as I said, it's one of the fastest growing resources in Australia. It's 70,000 ounces a month, month in, month out, and we intend to keep those drill rigs going and look for further discoveries as we're de-risking and moving into production. And of course, that creates the opportunity for an increase in the share price along the way and to maximise that value. Over the last 18 months, we've gone from being, as I said, an exploration company to moving into production, and the team we've built over the last few months is great. We've got Luke Gleeson with us in the room as well, who'll be here for questions afterwards. Luke's come across from Northern Star. He's been with us for a year now, so the expertise that comes with that. We've got Craig Jones, who our Chief Operating Officer, again, ex-Northern Star, instrumental with Northern Star and building mines and getting them up and running. So a real track record, a real history of building mines and getting into production on time, on budget. So we're located in a fabulous jurisdiction. So Western Australia, as we all know, is the place to be for gold. And we're located about 4 hours drive up the road from Kalgoorlie and the Super Pit. Where we are, it's some of the biggest mines in the world, big Archean lode gold systems. We've got nearly 3,000 square kilometres there, so big dominant land holding. We've got Jundee, obviously Northern Star just to the north of us, one of their flagship mines. We've got Thunderbox just to the south of us as well, another one of their core assets. We've got Goldfields 30 kilometres down that Goldfields highway just to the south of us with Agnew Lawlers, and obviously a couple of other big mines as well. So Bronzewing and Darlot were two of the superstars back in their heyday as well. So it's got a real history of mining, and of course, for us who've only been on the project for 3 years, to get to 2.7 million ounces of resource growth so rapidly, you can see this really carrying on for a long period of time. We've got granted mining licences. We're just outside the main town, and the gas pipeline runs right next to us. So you can see a real fast track way for us to get into production by Christmas next year. Our feasibility study that we put together, it's been done by industry experts, so NTEC ran that for us, and NTEC is one of the premier engineering firms in Western Australia. They've been involved in a whole bunch of things from, evaluating the Super Pit for Northern Star and Saracen through to, obviously us as well. So these are household names, and the study that we've done is obviously very robust. And one of the key things we pointed to in our study from the independent experts to get this done, and with the background of the Northern Star help that has come across with Craig Jones and Luke Gleeson, is to really put a level of conservatism into that study. As Paul said at the start, what we do in Bellevue, we pride ourselves on actually doing it and achieving it, and having that track record. And of course, pouring gold on time, on budget, and delivering better than what the study does is obviously a key focus for us. So some of the metrics you can see in here, we're typically about 15 to 20% less is what we're putting in there compared to industry averages. So we're not pushing the study at all. These are very conservative numbers, and there's a big level of conservatism put into it. And on long section here, so from top to bottom, you can see the various loads that we've got, and you can see the various mine life at the start, year 1 through to year 7.5 marked up in colour there, and the various loads that sit in there. So there'll be 4 mining faces going at the time. We'll have 5 jumbos operating. But what's really important to realise on this slide is that we're blessed with the existing infrastructure. And so there's a decline that already exists. We're going back down there right now. We're stripping it out. And we've been doing this for 10 months. So we're already well advanced. We're 10 months into this. And we're 1.5 kilometres down that decline. So that puts us in a real strong advantage. And that allows us to not only get to the ore body quickly, but it also allows us to get drill rigs underground. And we currently have 2 drill rigs operating from underground. And what that does, it means that instead of your 9 drill rigs on surface drilling from surface, costing more and taking longer, you can actually drill quicker, more efficiently, and of course your resource upgrades can come out quicker as well. So I've got a very quick flyby of the ore body to get a bit of a feel in 3D on how it looks. So it's a multiple stacked lode system, typical Archean lode gold and basalts and dolerites, quartz veining. And the strike over it so far is 4 kilometres from the northern end to the southern end, and it's very much open north, south, and I'll be showing you shortly it's open at depth as well. So stack lode system, the resources, the yellow's the inferred category, the blue's the indicated category, obviously as you bring those drill spacings down. And what we're doing at the moment, we're converting those yellow areas into blue and more indicated category, which of course is then results in increase in reserves. This is all the development for the stage 1 feasibility study, taking its life of mine to 7.5 years currently. And you can see there the new area that we discovered since the previous feasibility study called Marceline, and this is one of the areas that's going to be coming into the new Stage 2 feasibility study. And Stage 2 really is about more ounces coming in and increasing the profile of it. So the existing infrastructure, as I said, that blue decline, we're almost 1,500 metres down that now, and of course, being able to drill from underground makes things much cheaper, much quicker, much more efficient, and it allows us to target below the main ore bodies as well. So everything we've been doing to date is really targeting that sort of 500-600 metres below surface, and all the resources really are stepping out to the north and footwall, hanging wall in that top 500-600 metres. But what we've done, we had co-funding from the West Australian Government, and we drilled 2 holes down to about 700 metres depth. And you can see here these EIS targets have come in, so we know there's another lode sitting directly below. And so once we're underground with those rigs, we can start really focusing on that. And the other exciting aspect about this, about why we've found the gold so rapidly, is that we have pyrrhotite associated with the ore body as well. And what pyrrhotite is, it's a sulfide mineral that is a bit like a nickel sulfide, and so you can use downhole geophysics. So we use downhole electromagnetics on every drill hole we do, and what that does, it vectors us in on where the sulfide material is, and every time we've drilled one, we have a 100% correlation with high-grade gold. So all those green areas that you just saw before, they're targets that haven't been drilled with pyrrhotite in it, and so the chance of high-grade gold is huge. So you can see this why we're continuing to drill on exploration, stepping out, because we can see that there will be further resource growth in that top 500 metres, and then once we're underground, targeting from below that. So it's a very exciting discovery. And so just a couple of slides on what the actual numbers of the feasibility study are. So at the moment it's a 160,000 ounce a year production profile for the first 5 years or so. And that puts us in the top 25 gold mines in Australia. So it's certainly got scale, but what you're going to see, as I said, is more resources coming in, so we're upscaling on the Stage 2 study. So we'll be hoping to move up that to the right-hand side of the screen. And of course, the costs are low as well. So we're in the bottom quartile of all-in sustaining costs, and this is every cost put into that. So we've got underground drill rigs included in that. Everything for the whole life of mine is included in those all-in sustaining costs as well. So every bit of growth that we're talking about is in those costs, fully coded. So we're at the bottom of that cost curve, which is great to see. And of course, ESG is an important part to us as well. So we're planning on being the green and gold miner here in Australia, and for us, carbon emissions and gas emissions are, of course, making sure that we are at the forefront of leading that. And you can see at the moment we're one of the lowest, or we're planned to be one of the lowest in Australia, and we're hoping to move that down to be number 1 in the near term as well. We're blessed by the grade, and of course, grade is king, as we all know. It's the second highest grade ore body in Australia, outside of Kirkland Lake's Swan Zone, and the grade has been consistent throughout, and we expect that to continue as well. So we're very blessed with that. And of course, what does this all mean? Well, the most important thing to do, right, in a gold mining company is to be profitable. And so with scale, growth and profitability, you can see here this is going to be one of the most profitable gold mines in Australia. And you compare us to the really good producers that are out there that are low cost, that are doing well, and you can see this is without a doubt one of the standouts when you look at it either as an EBITDA margin or you look at it as all-in sustaining cost margins as well. And so what does that mean? Well, to be quite crass, it means that it prints money. There's going to be a lot of money coming out every day from this project. And in fact, the first couple of years, it's going to be doing just under $200 million per annum on that in free cash flow, which is actually pretty amazing. And so future growth, I've said it several times, this slide shows the growth that we've had. It's every 6 months or so we update the resource. We're on track for another one coming out with our updated bigger and better stage 2 study shortly. And don't forget, reserves are going to grow. We're focused on half reserve growth conversion and half on step-out drilling as well, so you'll be getting both of that coming out. And then, of course, just remember this is an Archean low gold system, and if you reflect back to that map that I showed you earlier of where we are in the gold fields, you can see here on the other side of the screen that these gold mines in Western Australia go for a very, very long period of time, decades. They're company-making type projects, and of course, when you look at the bottom there, they're typically owned by big companies. So we're very fortunate that we, as a junior company, have this as our stepping stone for growth. I won't dwell on this slide. This is a long section through the ore body, just like what you just saw in the flyby. And you can see, the resources there marked up in red, down to about 500-600 metres vertical depth, very much open at depth. You can see the limit of the drilling that we've done to date, and the green areas are those target areas that we're drilling. So the Amand and Marceline areas, you saw the maiden resource come out in Marceline. The importance of that is it's shallow, it's right next to an existing infrastructure as well. So that's going to be coming into the new stage 2 study, and you can see all those targets to the north and south that we intend to test over the next 6, 12, 18 months as we continue to expand and grow that resource. And on the timeline to development, as I said, we're on track for coming out with that study around the middle of the year, as we've said. With resource upgrade with that, you'll see, you'll see the first phase of how the bank debt is looking coming out in July of this year as well, and then on track for first gold on Christmas next year. And so, look, we really are very lucky to have the grade that we have. It sets us out from, as a standout compared to a lot of gold mines in the world. As I said, most gold mines are operating at about 1 gram per tonne. We're 10 times higher grade than that, which means that's why it is going to be super profitable. And the growth on this project is just outstanding. As I said, with 9 drill rigs turning, you see conversion from going from above surface to underground, increased rates, cheaper costs, and obviously getting that resource growth happening while we move it into development. And of course, we have $116 million in cash, which really does set us up to be able to do everything that we're saying that we're doing. So thanks very much for your time.
Thanks very much, Steve. As you can see, that's a story going places in a rush. There's several buy recommendations out on that stock, I think, ranging with price targets ranging from about $1.20 to about $1.50. So that's terrific. Steve will be here to have a chat after the next presentation during the lunch break, and then he has to get a plane. So if you'd like to have a chat to him after the next presentation, please do that. We're going to move into our next presentation now. If I could ask you all, please, to keep the noise down, because it's very hard for other people to hear. It echoes around this room, as fantastic as it is, and also makes it very difficult for people watching online. So please, if you do want to have a chat, please go out to the foyer. No offence taken at all, but please don't do it in here. Our next presentation today is Centaurus. Now, there's plenty of people in this room who remember in the old energy world of hydrocarbons and the like, there was a fantastic advertising slogan, oils ain't oils. In the new world of energy, there's a new one emerging here, nickels ain't nickels, because not all nickel is suitable for use in lithium batteries. It has to be a special sort of nickel. Centaurus has that sort of nickel, and it's just putting the finishing touches to a study that will demonstrate why that nickel is perfectly suited to use in lithium batteries. To tell us about the project, where it's going to, and its suitability for batteries, please welcome Darren Gordon.
Hello everyone, thanks for being here. It's a great pleasure to be able to talk you through the Centaurus story. Something a little bit different to what Steve's just presented with gold. We're nickel sulfides in Brazil. And it's with great pleasure that I can sort of talk to you about this project that we picked up about 18 months ago from global major Vale in the country. Now, we've been in Brazil for over 10 years now. We started out life there looking at some iron ore assets. We've shown that we can take projects through to being through the development phase, and it was really a lot of that work that we'd done previously that enabled Vale to be confident enough to deal with us and let us have a look at this very significant project. So when we picked it up, Vale had already drilled about 55,000 metres of diamond core. We saw a lot of opportunity for the high-grade zones. It was a project probably that just didn't cut the mustard as far as size for them, and I'll explain why when you look at the size of the deposits that Vale does have in their portfolio. You've seen a few of those in your time. So when we first got this project, we were always believed that this could be a 20,000 tonne per annum nickel producer. And everything that we've done in the last 18 months since we've picked up this project, nothing has really changed our view. It's actually only further confirmed our belief that this really is a globally significant project. Over the last 18 months, we've completed a lot of work. We've put out 2 JORC resources, first one in June last year, and then more recently in March, just prior to putting out our scoping study, our base case scoping study, which is to look at a traditional nickel concentrate as the product. So we're in the world-class Carajás region of Brazil, and I'll go through that and why that's important. But the project itself has over 500,000 tonnes of contained nickel metal. So there's not too many places where you can get 500,000 tonnes of contained nickel metal in a sulphide deposit. I think in the Australian market, BHP and Western Areas are probably the only 2 companies that have got a resource base bigger than this. When you look at then, we've converted about half of that resource into what we call the production target. We can't call it reserves yet because it's still in the scoping study phase, but there should be a pretty close correlation between the production target and what ultimately goes into reserves as we do pre-feasibility study work. But those numbers demonstrate a really, really robust project. We've got 10 years of plus 20,000 tonnes of nickel production. That gives us an NPV post-tax of over $600 million and an IRR over 50%. Now, with payback under 2 years and operating costs around $2.40 a pound, we know that we're a very low-cost producer, or will be a very low-cost producer, which sets us up well to weather any storm that you might see in the nickel markets. But with the amount of metal that we actually have in the project, we've got huge upside and leverage to rising nickel prices, which we believe will come through the course of this decade as the EV thematic really kicks off. It's only really as recently as, I think, Tuesday night, you had Joe Biden come out and say that in the US they're looking to spend about $175 billion to stimulate and promote the EV market in the US. So that's going to be hugely important, and at the end of the day, people are going to be looking, where do they get the nickel from? And this is a great source for that as an undeveloped asset. Outside of the economics of the project as it currently stands, we've got a 65,000 metre drill program underway this year. Steve alluded to it in his Bellevue presentation. It's important to be able to do study work, but also to be able to continue on with your exploration and demonstrate the growth that the asset has. Our resource is sitting in the top, within 200 metres of surface, about 80% of it. So there's still a lot more mineralisation to be found at depth. We just haven't needed to do that work at this point in time. So the drill program this year will hopefully show that we've got a lot more legs in the project and the resource will continue to grow. So when you're in Brazil, it's important to note where you are, and the Carajás Mineral Province probably is one of the world's best mining provinces anywhere. If you look at some of the deposits that sit on there, Salobo, top of page, is over 1 billion tonnes of copper. They produce about 250,000 tonnes of copper and about 350,000 ounces of gold a year out of that mine. They'll do that for the next 50 years. Those 2 mines, deposits along strike, Paulo Alfonso and Furnace, they're undeveloped. So you've got 500 million tonnes of undeveloped copper sitting in this area. If you go further south, you've got the Sossego mine, another operating copper mine, and then you've got the massive S11D iron ore deposit. It's the biggest mine, highest grade iron ore deposit anywhere in the globe, and there's just been a huge amount of infrastructure that's been spent in the Carajás, which puts us in a perfect position to be able to develop this asset. So I can fly on a 737 jet into Carajás airstrip. Parauapebas is about 250,000 people. All the mining service providers are based there, so you've got plenty of access to services and skilled labour. There's high voltage power throughout the whole region, sealed roads down to where our project is, and even as for what we've got, Onça Puma, which is Vale's nickel laterite deposit, only 15 k's from where we are, they've had about $3 billion spent on that asset alone. So you can sort of see that with that amount of infrastructure in the region, it gives you every chance to be able to get this thing up and running pretty quickly. The other part about it, as you can see from the map, we're dealing with farmland. There's not a lot of hills in the region. It's pretty open, not a lot of vegetation. So nothing really that becomes a major impediment to getting a project up. The other side of that is, we've got low-cost power. Most of the power in Brazil comes from renewable sources. About 65% of their power is coming from hydro. Another probably 10 to 15% from solar, and that solar generation is growing. It's in all likelihood that we'll have a project that's 100% on renewables, which is obviously beneficial from an emissions perspective, but also from a cost perspective, we're going to be able to access power at very low cost, hence why our costs at $2.40 a pound are as low as what they are. Our processing costs are low. You can sort of see in the pictures there the town that's Tucumã, where our guys are based, pretty decent sized town. Vila do Conde is the port where we'd look to export our nickel concentrate from, and this is the top picture there is just an example of the hydro facilities that they have in country where the power's been generated. And I think the other thing, when we're eventually looking to sell our product into the market, we're close to all of the key markets. From Brazil, it's not a very far shipping distance up to where the end use of the nickel is going to be. So just looking at the resource, as I said, about 550,000 plus tonnes of contained nickel metal. Most of that sits in the area known as Jaguar South and Jaguar Central. As I said, about within 200 metres of surface, you've got about 80% of the mineralisation, and that's why, with the study as it's gone, most of the production is coming out in open pits. So this deposit's a little bit of a rare beast in that it's got relatively high grades, but in an open-cut mining situation. You find that most nickel sulphide plays in Australia are deeper underground deposits, or alternatively, if you're a pit, you're a much bigger, lower disseminated sulphide system. We sort of sit in the middle where we've got the benefit of open pits, but we've also got grade. So from that resource, there's about 260,000 tonnes that is in the current mine plan that's going to get fed through the concentrator at around sort of 1 to 1.1% nickel. And that's again going to generate significant cash flows for the company as we look to develop the asset. Strip ratios are low. We've been pretty conservative in how we've approached the mining scenarios to date. And we think that as nickel prices rise, we've got the ability to take these pits a bit bigger. The flow sheet for nickel concentrates is a very simple one. It's been done many times before. There's nothing complex about it. Different reagents might get used between different circuits, but for most part, all of this is a bit of a known quantity. We produce a high-grade concentrate at around 16%. One of the other important aspects is the iron to MgO ratio. So when you talk to smelters that are looking to buy the concentrate, this iron to MgO ratio is a very important characteristic that they look for. So the higher that is, the better. I guess the other thing that when you're dealing in Brazil, which has obviously been an issue in the last few years with Vale's being their tailings dams and what's happened there, obviously it's a pretty important issue for everyone concerned in the industry and also particularly in Brazil. We've been dealing with the environmental agencies about our tailings dam concept. So what we're looking to put in place is an integrated waste landform, which has been used very extensively through Western Australia. It is, outside of putting your tailings into a disused pit, it's the next best option and has the highest safety factor against embankment failure. And the environmental agencies there are really getting behind this concept, and I think it'll become the new norm in Brazil to be able to roll out structures like this. We don't have the luxury of being able to dry stack in this part of the world. There's just too much rainfall during the wet season, so we've got the next best option. The footprint is very small. You can see the pits there, Jaguar Central and Jaguar South, and the processing plant at the bottom of the page. Again, the footprint of those things are not very big. So just reiterating on the numbers, we've seen those before, but we've got this 20,000 tonnes of nickel concentrate to be produced over the first 10 years of the project. We do think that will grow. We also think that the EV thematic is real and that you are going to see rising nickel prices as people look to chase not only nickel but green nickel. So to be a sulphide producer, to be able to source your power from renewable sources, this is going to be highly sought after, and I think there becomes a premium for these sort of deposits. At $9 a pound, which is only about $1 a pound above current spot prices, this project's pushing out over $1 billion post-tax NPV with an IRR over 80%. So we think that the leverage to nickel prices is huge, and there's not too often that you see this sort of opportunity. Just to put it in perspective, at 20,000 tonnes a year, we're probably going to be sort of somewhere between the top 5 and top 10 producer globally, outside of what happens in Russia with Norilsk. So it's a very significant deposit, very significant production profile, and we do still think that it's got the ability to grow. Paul alluded to it in his introduction. The other thing that we're looking to do now is to complete a value-add scoping study, and by definition it should add significant value to the project. And what we're looking at there is to produce a nickel sulphate which can be sold directly into the battery market and the battery manufacturers. One of the key reasons for that is it's just the economics of the project. When you're selling a nickel concentrate, you're giving away 25% of your revenue stream to the smelters. That's the payability discount that they will apply when they're buying nickel concentrates. So we want to be able to recoup that, get that back to LME prices plus potentially a premium that goes into it, and that could give us 30 to 40% more revenue on the project, which may be over $1 billion of additional revenue. The other side of that is that we've got low power costs, which means that we can generate the oxygen needed to run these circuits, and it is also putting us directly in contact with the battery manufacturers, which we think is where you want to be in the sort of years ahead, and having them as your customer. So the study should come out in the next couple of weeks. We're working away vigorously to complete that. And yeah, as I said, I think the numbers when that comes out will present a very nice value add to what is already significant economics for the project. The environmental licensing is coming along really well. It is going to be the time determining factor for us to get into production. The environmental impact assessment, which is the key document that we need to lodge, we'll be getting that lodged probably by the end of June. We're just waiting for the scoping studies to be finished so that we can pick up all of the final design of the pit, the waste dumps and the tailings dam, drop that into the document. We've completed all the wet and dry season data collection for the flora, fauna, water, dust, noise, all of the things that need to go into the study. And then that really kicks off our approval process. And with that approval process, we'd be looking to get what they call the installation licence in Brazil by the first quarter of 2023. So there's a two-stage process. The EREMA goes in, you get your first stages, your preliminary licence. We'd expect that after 12 months. We'll then make application for the installation licence. That should take another 9 months. And then, so first quarter 2023, having those licences and the mining lease granted, which will then allow us to start construction hopefully by the third quarter of 2023. So this project's not too far away. In the context of nickel sulphide players, there's just not too many that are in the pipeline that can meet this sort of timetable. And as I said, one of the other aspects that we're really keen on is to continue the exploration push. So if you think about the resource that's developed this 500,000 tonnes of contained nickel metal, that's based on 75,000 metres of drilling. We're going to do another 65,000 metres of drilling this year, and why we can do that is we've now brought in an RC rig, which hasn't historically been used on the project. But whilst we've also got that RC rig doing 25,000 metres of drilling, we're going to be testing some of the deeper zones under the known deposits with further diamond drilling. So we've got 4 diamond rigs on site, 1 RC rig. We've got 2 more diamond rigs coming at the end of June and another RC rig at the same time. So we're going to be very, very active with our drilling, and that's because there's so much more to be found. You can sort of see some of these cross-sections there. On the left, Jaguar Central, that's where we've been having, I guess, the most recent exploration success. There's a hole there just at the bottom of that pit, which ran 30 metres at 3.3% nickel, which we got just before Christmas last year. That contained that drill core there, which had 12 metres running 5%. And that's sort of down around 180 to 200 metres depth. So we're not talking very deep zones yet, but we can continue to trace these trends deeper and hopefully find more mineralisation, which will either extend the pits in those locations or introduce new underground locations for future mining. The other part of the exploration is the EM. Electromagnetic geophysical surveys are a very powerful tool in this part of the world. We've used them quite extensively. Generally where we've had EM conductors, we've been able to find sulphide mineralisation of varying grade, but still showing us that we're in the right zone. So there's a number of areas where downhole EM has shown that we've got EM conductors well below the depth of our current drilling. So we've got to step back and start doing some of that deeper work and hopefully get more of this, these sort of results. And this is just, I guess, a map of the RC drilling, the light green outlines of where we're going with our, I guess, more greenfields work. We've infilled the soils, we've infilled the magnetics, we've done fixed loop EM, and which has allowed us to generate all of these targets, and that needs to be tested over the next 12 months. So very busy times ahead from an exploration point of view, but also working away on our studies. And what I would just say is, obviously it's been difficult for us to be able to get to Brazil. I haven't been able to do that for 12 months, but the reason we've been able to be so successful and continue our work activities in country is because we've got a fantastic team on the ground. Most of the guys in my team I've worked with for over 10 years. Very loyal, very reliable, get on with the job, and that's allowed us to be able to continue to drill over all this time. We've got good support on the register, top 20 owning sort of 60% of the stock. And I guess just fundamental takeaway for me is that we've got a market cap of 240 million. We think it should be higher. We think the project demonstrates that just through the base case alone. The value add should continue to show that there's a massive gap between that market cap and the value of the project. And as we find more nickel in our drilling, I think that message will just continue to be hit home over and over again. So that's, I guess, the key takeaways for Centaurus. We're nickel focused. We've got a great resource. We're converting that into a very economic project. And you've seen that with the sort of, I guess, the project metrics of low operating costs, early payback, good NPVs, good IRRs. We've got a further study coming out which shows, or should show, that nickel sulphate is going to deliver more value to the project. And we're still well funded. So we've got 20 million in the bank. We've got options that are currently being exercised, which should lift that up to about 25 million bucks, which gets us through all of the pre-feasibility stuff, pre-feasibility study work that we need to do. So I encourage you to take a look. It's a little bit different, but we think it's a cracking project. So thank you for your time.
Thanks very much, Darren, and you can see why Darren likes to say nickels ain't nickels, because they've got the right nickel. We're not going to stop because lunch has obviously been served. We're going to keep moving. But if anyone would like to have a chat with Steve Parsons, he's got about 10 minutes before he gets the plane. He is outside. Otherwise, we're going to keep moving on with our next presentation. Now, when I say the name Pilbara Minerals, I see many smiles on many faces in this room. With very good reason. It was a big win, wasn't it, for many of you? And fantastic. That's what Resources Rising Stars is about. I think we introduced a Pilbara mineral story to this audience at the whopping share price of about 2.5 cents. I remember our next presenter, who barely needs any introduction, Neil Biddle, the founder of Pilbara Minerals, standing up here telling us about this little thing called Pilgangura and a product called lithium, and how it was going to be so important in this new world of electric vehicles and lithium batteries. Some people's eyes glazed over, others lit up, and those that lit up have plenty of good reasons to be so happy today. Neil decided he might have a little time in retirement, but it didn't work out. He decided that's not for him. There's only so many fish one man can catch or eat. So he's back. He's back with a new project. Again, it's got a product with a difference, and he's going to tell us all about it. Please welcome Neil Biddle.
Thank you, Paul, and good afternoon, everyone. It's wonderful to be speaking in front of such a large live audience again, and thank you very much for everyone making the effort to be here today. It's much appreciated. Greenvale's a new project for me. I took over the management of the company about 9 or 10 months ago. There's two projects we have in Greenvale Mining. The unique Alpha Torbanite project, which we inherited. Greenvale's owned that project for over 40 years now. And the Georgina Iron Oxide Copper Gold project, east of Tennant Creek in the Northern Territory, is a project that I and my associates vendored into Greenvale. Greenvale has a very simple capital structure, 393 million shares on issue, currently capped at around $100 million, just over $10 million in the bank. It's quite tightly held. The top 20 shareholders own over half the company. The three directors are the three largest shareholders. We have 25% of the company between us and a fair bit of money invested. We have a fourth large shareholder. We've just taken on board a Sydney resource fund who put in $3 million a few weeks back, and they hold just under 5%. The Alpha Torbonite project is, we inherited it. It's a unique and unusual project. It's not the kind of project I normally would look at, but what sparked our interest was a SRK scoping study. SRK are a highly reputable geoscience consultancy with global affiliations. And the SRK scoping study, which was completed early last year and before my time, concluded a base case gross revenue of $1 billion from Alpha over a 10-year mine life. And those kind of numbers are always going to be of interest to us. So the low capex, low opex which we discovered when we drilled down into the scoping study were all achievable. So we made the decision towards the end of last year to take this project to feasibility. It's located in central Queensland, 500 k's west of Rockhampton. It's 2 hours drive west of Emerald. It's on the northeast margin of the Galilee Basin. It was discovered in 1939 and it's had an 80-year history of intensive exploration up until probably the early 1990s, and it's sat dormant since. The torbonite itself is an ultra-high-grade hydrocarbon-bearing carbonaceous rock. It's not technically an oil shale. Oil shales have some structure, they're laminated. The torbonite is a massive rock. It's formed in a freshwater environment. It's massive in structure. It's the hydrocarbon content of 650 litres per tonne makes it way and above the highest grade of that type of material in the world. And I think this particular torbonite is the highest grade torbonite in the world. Torbonites being what they are, such high-grade, unique rocks, most of the torbonite deposits in Australia were mined out in the 19th century, and other torbonite deposits elsewhere in the world, in France and Scotland, have long since been mined out because of their grade. Torbonite's very unique. When it burns, it doesn't emit any flame or smoke. It just glows red. So it was pretty highly valued in people's fireplaces. The SRK scoping study contemplated and made some assumptions and contemplated production of 100,000 tonne a year of bitumen, about 80 million litres per annum of light crude, and spent shale, the spent shale or spent torbonite of about 250,000 tonne per annum. Subsequent test work by ourselves and previous test work by universities around the world have demonstrated that the torbonite does upgrade, the spent torbonite does upgrade to a very high-grade activated carbon, which has a very high value and wasn't contemplated in the SRK scoping study. The main product, bitumen, will underpin the project. Amazingly, Australia imports 100% of its bitumen, and 50% of that supply comes from the mega refineries in Southeast Asia. Australia stopped producing bitumen when it closed most of its refineries, which progressively closed between 2008 until very recently. There's only 2 refineries left in Australia. They process or refine the locally produced light crude oil, which doesn't produce any or very little bitumen as a byproduct. The balance of our imported bitumen comes predominantly from China, about 40% of our total requirements, and the balance from the Middle East. So Australia is entirely dependent on imported bitumen, and the demand for bitumen in Australia and elsewhere in the world, with government spending fortunes on infrastructure post-COVID, the demand for bitumen has grown rapidly. There is intense interest in this project from local importers of bitumen and local end users, the asphalt producers, have had intense interest. The activated carbon market, which is the third product that comes out of the alpha torbonite, is one of the fastest growing commodity markets in the world. Activated carbon is used extensively in industry to clean industrial emissions. In Australia, it's particularly used in cement plants and in food plants to remove mercury. And mercury is very attracted to activated carbon. It absorbs it and it doesn't release it in the ground, so very valuable use. It's worth about $800 a tonne in that situation. It's also used extensively in water processing, sewage treatment, aquatic centres, and in water purification, particularly in the third world. It's also used extensively in the gold industry. It's used to recover cyanide from leach solutions in CIP and CIL plants. And of course, all our activated carbon, industrial activated carbon, is imported mostly from China. So again, very strong interest from local markets. The third product that comes out of the alpha turbinite is light crude, 80 million litres forecast in the SRK scoping study. That actually will blend with the bitumen to make a spray-on bitumen product. It blends at the rate of about 20 to 1, so 80 million litres of light crude will mix with 4,000 tonne of bitumen, and there's a ready market for that product right throughout Australia, where spray-on bitumen is very commonly used. One of the issues we've had at Alpha is the test work. There's no retorts in Australia, there's none in laboratories at any scale, and there's none in production, so we've had to build our own retort. The retort is basically a big oven which heats up to about 650 degrees centigrade. It extracts the bitumen, which drops out the bottom of the retort. The light crude comes out near the top of the retort into a distillation column, and the gas comes out the top, gets recycled, gets cleaned up through activated carbon, and goes back into the retort to keep the combustion moving. We've built our own retort and it's sitting in a laboratory on the Gold Coast. We're currently processing a bulk sample, and we're using the results from that program as a citer for a definitive program to be undertaken by ALS laboratories in Brisbane. And that process is expected to take around another 3 months, and that will give us Australian standard labelling for our bitumen and our activated carbon products and our carbon products. The other product that comes out of the spent shale is a carbon which can be sold to the metallurgical coal industry as a filler for coal. It's only a $100 a tonne product, but nevertheless, that market's there. We've just put 85 drill holes into Alpha to bring it back to JORC compliance. There's been extensive drilling done at Alpha historically, about 68 holes. There's been extensive test work done, but unfortunately all dating back to the 80s, early 90s at the latest. So none of it is JORC compliant. We're not able to use it to calculate a JORC resource. We need the definitive test work from ALS to apply a grade to the resource, and we've re-drilled completely we've covered the whole area, and that work has resulted in us collecting a considerable amount of core, which is now being refrigerated in the laboratory in Brisbane to stop it oxidising and ready for testing. The drilling has given us a very detailed look at the turbinite deposit. It extends from over about 4 kilometres strike length and almost takes up the entirety of our mineral development lease. It does extend into our surrounding EPM. That's an in situ strip ratio model. The blue's good, green's good, yellow's not bad, and by the time it gets to purple, that would be sub-economic to mine, quite high strip ratios. But basically in that model, it's about a 20 to 25 million tonne resource. Our second project, Georgina, is a mighty project. You're going to hear a lot about it in the next few years. It's the result of a collaboration between Geoscience Australia and the Northern Territory Geological Survey. They've been working on the project for the last 5 years. They've spent $40 million out there as part of a national initiative, Exploration Undercover. The federal government has put money into supporting this endeavour. The ground's been held in moratorium for 5 years. No one's been able to apply for tenements out there. It came up for competitive tender at the completion of the Geoscience Australia work. I'd been following the project for a number of years. I have a strong interest in the Tennant Creek area, and we were early movers in the application process. So we were competing against some of the majors, Newcrest, Tech Corp from Canada, and some very lively juniors, so it was pretty competitive. But we managed to pick up 4,500 square k's of 7,000 square k's we applied for. The underlying reason for the geoscience work is that there's a long-held theory that the world-class iron oxide copper goldfields of Tennant Creek and Mount Isa, in fact, are joined. They are. It's a continuous tectonic system, and the Geoscience Australia work, which culminated in 12 drill holes drilled last year, and results announced towards the end of last year, that work fairly much has proven the theory. We were hoping this year not to have to do too much at Georgina because we were very busy at Alpha, and we've only got one field crew, and we've only got one geologist, that's me. We're using SRK as our advisors, but that can be quite expensive, so very hard to get people at the moment. But two things happened at Georgina. One was the results from the Geoscience Australia drilling, which were just outstanding. Their 12 holes hit precursors to IOCG mineralisation in every hole. They even hit massive sulphides in one of the holes. And at the same time as those results were announced, we just completed our initial airborne magnetic survey, and the results from that sort of blew us away. So we, as soon as our field crew finish up at Alpha, which will be in the next 2 weeks, they're moving straight out to Georgina for a long stint out there. What you're seeing there is our tenement block, 4,500 square k's in 9 tenements. They're in red. 7 tenements are granted. The 2 in green are still awaiting grant. We expect to have that through July, August. They're subject to native title meetings, which we haven't been able to get on due to COVID, but they're expected to happen in July. The blue squares you see there are the sites of the Geoscience Australia drill holes. So we completed 15,000 line kilometres over 2 of our tenement groups. The northwest group, we covered that completely. That's about 800 square kilometres. The central group, we just did the northern tenement because that's where the 2 drill holes on our ground were completed. We got an instant hit on the northwest group. Some amazing anomalies, 2 walk-up classic Tennant Creek style iron oxide copper anomalies. These are magnetites that are surrounded by hematite and potassic alteration. They are walk-up drill targets. They're at about 250 metres vertical depth, and we are mobilising to drill those out in July, August. 3 additional high priority targets, but there's a host of targets coming out of this. You can see the resolution of the magnetics show the black lines of the faults and fractures which are necessary and precursors to the mineralisation forming, as that allows the transportation conduit of mineralised magmatic and hydrothermal fluids. And that's a blow up of the 2 drill targets, and we'll be on the ground running ground mag and ground gravity surveys over those 2 targets as soon as our guys finish at Alpha. The central tenement block, we didn't get the same resolution because there is some Cambrian cover over the top of the tenement, so we have to go back and refly that at 1 to 100 metres. But the southern area, we've got pretty good resolution of the regional data. That's Geoscience Australia data. In the red shows the magnetite zones, and in the yellow the linear structures show the hematite alteration which carries the mineralised fluids to the magnetites. The magnetites act as big geochemical sponges and absorb the copper and gold. The Tennant Creek field, historically, 7 million ounce gold endowment, about an 800,000 tonne copper endowment, world-class field. This is a comparison between the Tennant Creek field and our central tenement block. The only difference really between the two is that our magnetics are about under 250 metres cover. The similarities are remarkable, and it's just that our ground hasn't had the intensive magnetic coverage that Tennant Creek has. But that's just an outstanding, that's got everyone very excited, all the boffins. I can appreciate you looking at that thinking, what the hell, but believe me, that's got the boffins very excited. And similarly with the gravity, when you compare our central block, which is only 1,000 square kilometres, by the way, and really less than a quarter of all our ground out there, the upside here is just amazing. You're going to hear a lot about it over the next year or so. So the National Drilling Initiative, they drilled 12 holes, 2 in our ground, and what you're seeing there is massive hematite potassic alteration within brecciated granite. Mightn't mean much, but that's the precursor for IOCG mineralisation. That's what Geoscience Australia were looking for out there. And when that alteration is seen within and surrounding magnetite halos, then you've got a real good chance of finding IOCGs. And we've seen that already in the preliminary work we've done to date. So we're on the road to success at Alpha, final feasibility due in about 3 months, and we're well on the way at Georgina. So a lot to be done. Thank you very much.
Fantastic. Thanks very much, Neil. It's great to have you back. Right, our final presentation today is a story with a bit of a difference again. Something new for Resources Rising Stars. We've never brought a uranium story to you before. This story is one of great timing. Joe Biden declared that uranium is a fuel of the future. He's declared it a clean fuel. I think it's becoming increasingly obvious that if you want to meet your carbon, your CO2 targets and keep the lights on at the same time, then uranium is the only answer. Overnight, the International Energy Agency came out with a report that said if the world is to be net carbon neutral by 2050, as desired, then the amount of nuclear capacities in the world will need to double. One more factor that's going to come out of this presentation is that the incentive price, if you like, for new uranium mines is US $60 a pound. The current price is circa $35 a pound. So you can see there's a fair bit of upside there in what is already a tight market. Boss Energy is set to be Australia's next uranium producer. That will make it our 3rd uranium producer. It already has a plant in South Australia. It's mothballed, and it's just about to publish an updated feasibility study, which will then be followed by the completion of project funding and offtake. Duncan Craib's here to tell us all about it. Please welcome Duncan.
Thanks, Paul. It's a real pleasure to be here today, and thank you very much for the opportunity to present Boss Energy and its 100% owned Honeymoon uranium mine in South Australia. And I mean that thank you with utmost sincerity, as let's face it, Paul, the commodity's been in the doldrums for the past decade. It's been unloved. It's been a tough road to sort of survive. And then it feels like seemingly out of nowhere, here I am, part of the rising stars. But that's not wasted on me, as there's real fundamental reasons as for that increased interest that we've experienced, particularly over the past 6 months. I mean, it feels like a lifetime ago for me when I was working on the Husab mine in Namibia back in October 2016. The Husab mine's the largest mine that's been developed in the last 2 decades, which was part of Extract Resources, which many of you remember, I'm sure, from 2012 when it was a darling on the ASX. Back then, I received this phone call and it had an Australian prefix. So I stepped out of the management meeting on the mine site and it was actually the chairperson of Boss Energy, and he said, "Dunk, you've earned your stripes. You guys have just about commissioned the Husab mine. Why don't you come home and take a project on yourself? Boss Energy had just acquired from Uranium One the Honeymoon Uranium Project, and the chairperson said, we're assembling the same team that we had with Kalahari Minerals and Extract with that same drive that we can really build a project. So with that, I went home, had a good think about it, did a lot of research on Uranium One and Honeymoon, and it did have some technical issues that needed to be overcome. But that therein lay the opportunity, and something in my gut really grabbed me and thought, here's an opportunity to come home and take it on. So with that, we with my family, relocated back after 17 years of international mining experience, and in January 17 was on the mine site in South Australia. It's only restart projects that really have that benefit, the benefit to look back and capitalise on previous successes and where we could actually enhance technically. So since that time, since I joined, we've enhanced the JORC resource, we've dealt with our permitting, we've dealt with our native title issues, we've resolved all of those, but we've really been able to attract the best talent within Australia, and arguably on the ASX right now, we have one of the strongest operating teams at a board level, a team that's actually built uranium mines, operated uranium mines, and exported uranium around the world. So we've really put ourselves in a global position to seize upon this new market. We are endorsed by industry as being Australia's next uranium producer, and will be certainly one of the first to come back on globally. Honeymoon itself is a pure play uranium mine. It's a brownfield single mine asset that's previously, as mentioned, produced and exported uranium. In addition to those technical achievements, we've really been keeping in touch with our fuel buyers, the utilities around the world, and keeping them abreast of our technical advancements and reminding them that how close we are to getting back into production. And it's resonating well, particularly in the current environment we find ourselves with COVID. In 2 to 3 weeks' time, we'll be releasing our enhanced feasibility study, which builds upon the feasibility study that we released in January last year. The objective of this study is to further lower all our operating costs and increase our nameplate production capacity through the introduction of ion exchange technology. That technology accounts for over 50% of the world's supply of uranium and is the most advanced production one can use within this commodity. So essentially, this study is coming out to show a far more resilient project. But let's have a look at where we've got to at the moment and why we're so very, very excited about the space, because it's the macro environment that's really suddenly starting to give us a lot of attention within the sector. The past 6 months has been absolutely transformational. The uranium market is now on the cusp of recovery after a long period of low uranium prices. And what's really driven that is that the government policies to meet net zero carbon emissions is now becoming a global key point of policy for the various governments. If we look at the USA, if we look at the UK, if we look at France, if we look at South Korea, Japan, all have committed to hit those targets by 2050, and China as well by 2060. It's a phenomenal turnaround, and that sort of combination and direction of those governments adopting that policy and giving the sector that impetus was very much what I experienced back in 2005 at the start of the last cycle. We're seeing that increased electrification is bringing power to almost a third of the world's population that don't have reliable access to power, and that's needed to drive the global economies forward. We're also, one example of that was China with its goals by 2025 to increase their power from nuclear up to 75 gigawatt, which is a fantastic build program. But don't ever query that the Chinese will not be able to do this, because if you look back in history in the 50s, the 60s, early 70s, the global build of nuclear power plants far exceeds what's being planned for at the moment. Yet technology's improved so that you can build it quicker and more efficiently. As Paul mentioned, the $60 US per pound base case price is actually the incentive price that's needed to incentivise new mines to come into production. Currently, the spot price is $30 US per pound, so it's got some way to grow, and it's that investor sentiment right now that's front-running that expected increase in the commodity price that we'll soon see. Inventories have fallen, and we've seen that over the past few years, particularly with the Trump administration, where fuel buyers in the US were very reluctant to go against the administration and enter into long-term contracts with countries that may be subject to trade sanctions, such that we saw the Russian suspension agreement, Iranian waivers, etc. So all the while, the US utilities were just drawing down on their own stockpiles. Now, to enter into an offtake agreement, it's typically an 18 to 20-month period. So from the date of signing to first delivery, 18 months. To do that, utilities need to start entering the market now, and we're seeing a lot more increased activity and contact from fuel buyers indicating that that's about to take place. In fact, in the last 4 weeks, I've entered 3 requests for proposals, which is the tendering process producers go into, and it just shows the volume is now beginning to pick up, similar to what I experienced in the last cycle. It starts with a trickle, becomes a flood, and it can move very, very quickly. Primary production continues to decrease. While that incentivised price of 60 US per pound is high, and we're dealing now with a spot price of 30 US per pound, it's not enough to incentivise new development. New mines take time to be built, and a lot of mines have actually gone into care and maintenance, such as ourselves. Demand is rising, as mentioned, and the outlook for nuclear itself is very, very bright. Up to 1.4 billion pounds of uranium is expected to be the demand over the next 10 years. So it's got a very, very bright future to look forward to. The best independent graph I could find to give you a clearer picture rather than one that a company produces is one sort of formatted by TradeTech. TradeTech is one of the leading uranium analysts in the world. What it shows and demonstrates is that the orange bars on the screen there are when restart projects are required to come back on stream. And that's in 2023-24. And as mentioned, to sign up offtake agreements, it needs to start now if we're going to meet those goals of coming into production. The other interesting fact about this graph is that it's fully baked in terms of including all those producers that say they can produce, will actually produce. And that includes some of the big global players such as Cameco and Centaurus, whose operations have been affected by COVID. This was done prior to COVID. What COVID's effectively taught the industry and what it's done is it's bringing that recovery curve forward. So COVID's taught the world and fuel buyers that it's a really unwise strategy to place all their demand on just a limited number of jurisdictions and a limited number of producers. That's where Honeymoon stands out. We're another alternative Tier 1 jurisdiction to contract with. Let's take a step now into Honeymoon and where we are, and I thought the best way to try and walk you through this quite quickly is to sort of what do we look for in a uranium company from an investment perspective. We're also looking at M&A opportunities and acquisitions, but what are the key elements an investor should look at? The first aspect is what stage of development is that project at? Honeymoon is a very advanced stage. We're a restart project, and by that, the mine's already been built. It's currently on care and maintenance. Within 12 months, we can be up and running back into production, so a very clear pathway to development. The existing infrastructure is currently valued at around 300 million Australian, and it's in that Tier 1 jurisdiction. And Tier 1 jurisdictions are becoming also increasingly prevalent because of the ESG move around the world. We have a very strict mining regulation. The Mineral Council of Australia has recently adopted towards sustainable mining, which is a framework sort of built upon by the Canadian Mining Association, and that's now the framework from ESG on which we'll adopt, and it's gaining great traction. So a lot of the recent investment we've found around the world comes from sort of ESG principled funding institutions in North America and Europe specifically. We also look in a project for an IRR above 40%, and for us an NPV at least 2.5 times the capex. Our existing feasibility study gets us there at an incentive price of 50 US per pound, and we're about to build upon that in the coming weeks with the release of the new feasibility study. We've got extremely strong board and management, as mentioned, one of the strongest on the ASX, and our all-in cost, our operating cost, is in the lowest quartile worldwide at 30 US per pound we're already cash flow positive in the current environment, but we're not going to destroy our resource, sign up offtake at these low prices. Prices are going to rise, and we're going to be there to seize upon that when that happens. So having a quick just look at the NPV, it's very healthy. We've actually also just purchased some 5 weeks ago, raised $60 million, purchased 1.25 million pounds of uranium. That's a strategic purchase. The reasons for those were many, but primarily it's to give the utilities confidence that we've now got a strategic asset on our balance sheet of physical uranium that we can feed into offtake contracts during that ramp-up period of mining. Not many mining operations, or this will be the third one I've been involved with commissioning, where you can turn on a switch and it works straight away. There are sometimes slippage in that initial year or two as we ramp up to nameplate capacity, but then now the utilities have got the confidence that we can feed into it. They've also got the confidence that we have a strong, very strong balance sheet, and that's also going to help us within the company get better terms on debt financing as it's a real asset. We've also got significant brownfield exploration upside. Where we are, we're just across the border from New South Wales. It's about 75 kilometres northwest of Broken Hill. South Australia is the only state in Australia where uranium mines are in operation and producing. Olympic Dam's the largest, where uranium's a byproduct. And then about 300 kilometres to our west, we have the Beverley operation, which is privately owned. Beverley is also an in-situ recovery ion exchange mine that's been producing for the past 15 years. They're producing up to around 4 million pounds per annum. All of the material produced in South Australia is shipped through Port Adelaide, which has been shipping uranium for the past 30 years throughout the globe to all the conversion facilities, whether OECD countries, USA, Canada, Europe, and more recently into India and others. So it really is an international tier 1 jurisdiction, and that, again, going back to that COVID scenario, it's looked upon very favourably by fuel buyers. Because we've got a tough mining regulation and environment, we mine efficiently, we adhere to ESG principles, and we're another alternative within that sort of Western economy to draw inventory from. The other key aspect, of course, being the only state producing uranium, we've got a lot of access to local talent and industry know-how that have actually mined uranium and know the process. It is a more complex mining procedure. I think but the best part of all is that we've got full bipartisan state support, and we've also got federal government support, which is just fantastic. So when I look at the resource there in the deep yellow of the paleo channels, they're the areas that actually host uranium. On the right of the screen behind me, you can see a red box. The small red box, that's actually the mining licence. The mining licence itself is fully permitted with an export permit up to 3.3 million pounds. That has 34 million pounds of uranium, enough to sustain a mine life of up to 14 years at our nameplate capacity. Outside that JORC resource sits another 38 million pounds sitting in 2 domains called Jason's and Gould's Dam that we'll look to exploit once this feasibility study is released. Meanwhile, we've got a geology team on the ground now continuing on with geophysical work, really proving up drill-ready targets that you can see in asterisks on the screen there, such that when we are ready to get the rigs in, we know exactly where to go. And we've built this knowledge of an exploration target of up to 190 million pounds. That's in excess of the 72 million pound JORC resource, through assessing over 30 years of geochem, geophysical data, and really pulling that together in one geological database of 3-dimensional modelling. So we've got a very, very strong grasp of our resource. It sits about 100 metres in depth. The grade's around 660 ppm, which is very respectable from all global projects. Taking a bird's eye view of the plant, looking down on the top right of the screen, you can see the production well fields. They sit just adjacent to the actual plant. There are 4 that have already been established. In that particular area is enough for the first 4 years of mine life at a ppm or a grade of 1100 ppm, which is very high, and that enables us to pay off our debt requirements within the first 4 years of production. It's a fantastically, very well-built plant. I think it was very well overcapitalised. We've got access to power off the grid from New South Wales. We've got access to our own water. We've got road, rail access. We've got our own airstrip. The camp itself can house 200 personnel, although we only need about 80 once we get back into production. Our ramp-up period is within having made an investment decision. Within 12 months, we'll be up and running, producing just shy of £1 million, and then taking that up to £2 million. And with the new feasibility study coming out, we believe we're going to be able to take that up to £2.45 million. Then, once we step outside of the mining licence, we're going to be looked to exploit those additional JORC resources and take it up to our export permit of £3.3 million. Again, it's ion exchange and in situ recovery. Over 53% of the world's supply of uranium occurs through that manner. All the Kazakhstan operations operate that way, the operations in Wyoming as well. So the next steps, really, we complete the feasibility study and release that in the next few weeks. In parallel to that, we've been progressing our project funding, talking to debt providers throughout the world. We've narrowed down that field to about 12 predominant debt providers who have taken an active look. I've got them up to speed on the actual project. They're comfortable with it. We've signed confidentiality agreements. The next step is now just sharing the financial model from the feasibility study, such that when we do land an offtake agreement at the desired price, they've finished their due diligence process and we can move quickly. We've also been progressing, as mentioned, our conversations with fuel buyers around the world and keeping very close to them so that we can move quickly. That's a strategic timetable that we adopted from the get-go of the last 4 years. Purely for this basis, we've been managing our cash very tightly until we get to this point, but we now really see that the market's in a transformational move, and we think this is a new phase and the start of a new cycle. No further permitting is required, and we've got significant expansion and chance to expand upon our mine life, as discussed. So when we take a look at the board overview, I believe many of you would actually know some of our team's backgrounds. It's a very credible team. It's got Peter O'Connor as chair. He was the senior non-exec of Northern Star. Bill Beaumont credits him joining the company when it had a market cap of $300 million. He brought a lot of the global investment in over that forthcoming few years to where it took up to a $10 billion valuation. Peter recently stepped off the board with the merger with Saracen, and we're just delighted that he's joined us. It's a real credit. Bryn Jones, he worked on the Bellevue mine, that mine that was nearest to our west. He had 15 years there. More recently, he's been the COO of Laramide Resources, another international uranium near-term producer, but he's our technical director. Wyatt Bucks, the most recent director, and he's an absolute credit to the team. Wyatt, arguably the most strongest operating experience and project execution within Australia, within uranium projects. He started his career with Cameco. After 15 years, he was the managing director of the MacArthur River mine, and then he was headhunted by Paladin back at the start of the last cycle to take their flagship mine, Langer Heinrich, through from its commissioning to its nameplate production. Last 10 years he's been with First Quantum, so it's really great to get him. And then Dudley Kingsnorth is one of Australia's top metallurgists. So we've assembled a very, very strong team. This is the team to take you forward. And it's also enhanced by Sashi Davies, who I've had the pleasure of working alongside with for the past decade. Sashi is one of the world's top 5 uranium traders. She's part-time with us at the moment. Her other part of the week, half of the week, is actually physically trading uranium. She's a real dynamite within the industry. She's also on the board of governors for the World Nuclear Fuel Markets, which is our preeminent industry body representing over 73 utilities in 23 different countries. So we've got the right team, and as we've progressed the team and firmed that board, we've also tightened our register, and it's now got some really quality institutions involved. As you can see, Paradise, Tribeca in Australia, we've got Sachem Cove, a specialty fund outside the US, but just under that 5% threshold. We've got a number of leading Australian institutions who've all wet their feet quite materially in the stock in anticipation of what's about to happen next. Our capital raising, we raised $8 million at 4 cents back in March 18. We raised another $15 million in September last year at 6.7 cents. And 6 weeks ago, we raised $60 million at 14 cents that was subscribed within the first 12 hours. So it's a fantastic ride that we've had, and we've generated a lot of wealth for investors. To conclude, I'd like to show you one of the most widely distributed graphs that's shown in many presentations from uranium producers. It really just shows the historic analysis between spot price and term contracts. Term contracts are what we look to as what we will be delivering into. That typically commands a premium of around 20% above the spot price. So when you see the spot price today, which is currently around 30.8 US per pound, the contract prices are being entered into at a higher price. In fact, the most recent one was entered into at 38 US per pound. So as mentioned, our all-in cost is 30 US per pound. We're already cash flow positive in the current environment. But just remember, 60 US per pound is the price that's needed to incentivise new mines, and new mines take time to develop. So all the while we're recognising that the past 6 months has been transformational, those underlying fundamentals of increasing demand, lower supply and reducing inventories still bears relevance, and that's why the new mines are required. So, being a restart project and that ability to capitalise on a rising market, similar to what we experienced back in 2006 and 7, and I've got a colleague in the audience who shared that period with me working alongside, we really saw that the prices were moving $1 to $2 a week. It was a fantastic time, and we believe that this is just the start where we are now. So I'm sure many of you remember how buoyant that market was, but we clearly remember, and all those indicators are pointing to the start of this new market. So what's up to us now is really staying very close to the fuel buyers and being ready and getting ready to lock in offtake agreements with pricing mechanisms that can protect our downside, give rise to the upside, and allow us to track along with that increase in the market price. We're already finding that some of the utilities are now, in terms of just reaching out, they're also assigning technical engineering groups to do technical deep dives on Honeymoon. We've had 2 of the largest in the US do that, and we've passed those with flying colours. So while we're not yet there on price or quantity, we're not far off. So just to conclude, as they say, like this graph, the longer the base, the longer the space. Prices have gone and will go ballistic. Thank you.
I told you it was a good story, interesting story, something a little different. That concludes our presentations, and it concludes our function. Just a little reminder again about the conference, 12th and 13th of October. Love to have you there. If you can come up and spend a couple of days with us, 30-odd presentations, a lot of fun. Morning and afternoon tea every day, lunch provided, drinks at the end of each day. So plenty of opportunity to chat and have a bit of fun along the way. Thank you very much for joining us. Great to see you all back with Resources Rising Stars, and we'll organise another one of these sometime in the next 6 weeks or so. Thank you very much.